So you don't need to have so much money to be an institution trader, because it's all about the strategy of you having the psychology of an institution trader. And what are institutions? They are majorly the movers of the market, like banks, basically those guys that trade on Wall Street. Those are the people that really move the market. So unlike an average trader who is a retail trader that brings its small $100 or $1,000 or $10,000 or even $100,000, you bring it to the market, then on you leverage on sorry, the staff is calling me, I'll call him back. Let me send him a text. Sorry, give me a second. So, rather than being a retail trader that leverages on your stockbroker's leverage ratio, you are coming in with the psychology and the strategy of an institution. And this is very important when you're trading. So it might seem like it's not important knowing what the definition of forex is, but knowing these basics and preliminaries will let you understand when some things happen in the market, why they happen, and when you should enter the market, when you should go out of the market. Just some basic things that might not look like they matter, but actually matter. So, what is forex? Okay. Okay. So trading in the relative. I'm listening. Okay. So you made mention of a buy order with gold. Okay. Hello. Okay, I'm listening. Quick one. Quick one. Did the guy teach you anything called smart money concepts? That's a form of institutional trading strategy. We'll touch that, but let me hear what you have. Wait, so sorry, what exactly did he teach you? What exactly did he teach you? No, we're just gonna start from the beginning, but what exactly did he teach you, please? Sorry. The US what? Oh no. So the US market, what's it called? I'm listening. What's trading stock? You said trading stock. Wait, sorry. You didn't tell me what the US time king is called. Oh, New York. New York. Wait, so what times do we have? What are the different time zones we have? The Mexican one. That was correct. The Australia. Okay, the one you got is London. Australia, what is it called? Sydney. Sydney. So from today, today we're just gonna have a conversation, and I want to see if, well, so far so good actually. I did see that the tutor has not really done too much. So we're just gonna start from the beginning, like from the beginning from the basics. But regardless, still, I want you to start from tomorrow. I don't want to have a chat with you today. So from tomorrow, what I need you to prepare for tomorrow is to have a notebook and a pen. Obviously, you need a pen for a notebook, or maybe an iPad, whichever one you're comfortable with. Then, or a laptop that you can use notes on, as long as you are documenting these things, because there are some places where you'll be like plotting graphs and shit like that. Not like deep graphs, just like drawing candlesticks and knowing what your week and your tick are. Then also like drawing hammerhead or different structures of candlesticks. So if a notebook would be easier for you, then you can use a notebook. You can use the iPad, or a computer or a laptop that you can use to draw. As long as this is very easy for you to use. Convenience is the key. Then so your device that you're writing or you're jotting on, and then access to the forex masterclass account so that you can get the course ready and you can follow the structure of the course there, so you can follow the scheme of work that has been structured out. Yeah. So what else? Notebook, pen, access to class. Yeah, that's it. Also, we'll be using Google Meet.
Okay.
Yeah, so that.
Google Meet, I think the notebook of myself
Okay, so the thing is, in project management, there's something called Scrum. I'll be using a form of Scrum methodology for you, whereby, although I'll be teaching you the basics of what is forex, candlesticks, this, to help with developing your trading psychology and understanding of the basic things in forex. I would also start showing you how to actually start trading, because going straight to the money, innit? So I'll take you to your charts. You start seeing your chart. You start reading your chart. You start seeing your indicators. You know how to draw your support and resistance. Start knowing out some of your Bollinger banks, and your MACDs and your RSIs, and just indicators that you can use to trade. Then, furthermore, we'll now open a demo account for you, so that in your free time you can start practicing. Because the best part of me teaching you is because I'm a teacher, like I'm a teacher, and I realize that giving students, regardless of the age gap, giving them what is forex, and then first talking about the theory, then you now go to the practical, like students will be bored, and by the time you get to the practical they won't even really remember the things from the theory. So if you can link the theory to the practical and then you're showing them simultaneously, it will facilitate their understanding. So that's what we're going to be doing. So we're giving you the theory part and then the practical part simultaneously, so that you'll be using the theoretical things to be seeing how the market is working in real time. So we don't have to wait for you to learn the definitions before you now start using your charts. So as of tomorrow now, although you are going to be doing what is forex, you're also going to be opening your chart, but then you're also going to be creating a demo account, so that even when I'm not with you, you already know how to start trading. You start by the ending of tomorrow. My goal for you by the end of tomorrow is that you know how to open positions, you know how to trade, you know how to close trades, you know how to apply your profit, your stop loss, and your take profits. So by the end of tomorrow, you're like a proper trader, but that doesn't really know much about trading yet, but can trade. Then we'll now proceed to you knowing how to straight up go into technical analysis, your support and resistance, so that you know how the market works. But then you still wouldn't know like some of the terminologies in the trading market, and you don't know why some things are happening, but you can already do the things that are happening. And then you will now be simultaneously linking these things together. God, idiot. Yeah. Yeah, it is a fantastic plan. So yeah, now back to basics. So you're telling me the four markets. Oh, I did give you the gift. I gave you the gist. It is four. So we have four. We have Sydney. We have London. We have New York. There's one, the last one, Japan. But we're in Japan, Tokyo. So most of these places are usually capital cities, and it's more like it's centralized in each foreign aspects, whereby London is for Europe, then Tokyo is for Asia, Sydney is for Australia. Australia is a continent. Now Africa is not, which is very sad. Africa is very very sad. Africa is not really a major player in the foreign exchange markets, because if you ever try trading naira to USD or wherever in naira, you see that the market barely moves. The liquidity, the yeah, the liquidity and the what's it called, volatility is mediocre. So most people don't trade that because we are not a big player. So we only have four major sessions. We have Sydney, we have Tokyo, we have London, and we have New York. And New York works for both North America and South America. In fact, New York, especially the USD, that's the United States dollars, is the global currency. So if you are trading anything to anything, there's always a USD attached to it. So now we have something called major pairs. Have you heard of major pairs? So what are major pairs? No. What is gold in forex? Yeah, but what can it be classified as? Is it currency? Is it volatility? Is it what kind of commodity? Try. Gold.
I know a lot of people use gold as a reserve,
Okay.
but honestly, that's all I know.
Okay. Well, majorly gold is classified as a metal.
Oh,
Yeah.
okay.
So although in some CFDs it's classified as commodity, it is mostly classified as metal. So you can classify it as a commodity or a metal. But in most scenarios and in most volatile scenarios, it is traded as a metal
Okay.
because it is actually used as a reserve. And that's why if you trade gold in the forex market, it is very volatile. Like gold is one of the
Yeah.
very volatile pairs. Okay, so major pairs. So what are the major pairs we have? Excuse me.
Um, Euro USD, GBP
Also,
USD.
I'm using some notes in front of me here, so and I'm also taking notes of the things you know. Okay, so EUR USD, GBP USD. Oh, sorry, that part I said now was for was for the YouTube video I was making, because that might have sounded weird to you, like what is this guy saying? But then again, also it's not weird because I'm actually documenting your progress to know how far we've covered and the things we need to cover. So sorry for the interruption. EUR USD, GBP USD.
And under one of the major peers.
Try. In this class here, you can just try. You don't have to be correct. Just have fun with it.
Okay. So gold, New Zealand dollar USD
Mm-hmm.
is an Canadian dollar USD.
Mm-hmm.
Yeah, and I think Japanese yen as well. I think that's JPY.
Mm-hmm.
Yeah, I think those are the ones I remember. Euro, GBP, New Zealand, Canada, Japanese yen.
Wait, so you said euros, New Zealand, Canadian, Japanese. That's four.
And Great Britain pound.
That's five. You're
Yeah.
very close. Just two more left.
Mm. Yeah, I think
I'll give you a clue. A country that most people store their wealth in as a reserve.
Switzerland.
Switzerland. Okay. So what's the pair?
I don't remember. I don't remember the Swiss franc.
Yeah, Swiss franc. So what's the acronym? What's the abbreviation?
No, I can't remember the acronym.
So it's CHF.
Yes, CHF.
Then you mentioned EUR USD, GBP, GBP USD, JBY, JB,
Yeah.
JPY USD, CHF USD, CAD USD,
CAD USD and
ZD. That's New Zealand. Now remember we
yes,
said something about Sydney.
yeah. Australia is AUD.
Mm-hmm.
Did I get that right?
Mm-hmm.
Okay, so Australian dollar USD.
Okay. Thank you. So those are major pairs. Now what are major pairs again?
The list of what they are.
No, what are they? What are they defined as?
Okay, so they are the when you're trading the currencies of the major markets or the major um, countries' currencies against the USD.
Okay. Trying to look for an illustration. Come on, it's come to me. All right. So what are minor pairs?
Okay, so minor pairs now are the other currencies that are also available on the stock market, but not those of major countries. So those would be
Are they available on the stock market?
sorry, sorry, forex market. Sorry,
So what is the stock market? That's just a by the way question.
yeah, the stock market is the exchange where stocks and shares are traded.
Okay. And what is the forex market again?
Yeah, it's the exchange where currencies or commodities are traded.
Okay. Okay. Now you're saying something about
Yeah,
minor
so
pairs.
minor pairs would be the Mexican dollar USD. I think that's MX. No, MX what now? Is it ME? I'm not sure if it's MEX or MX. So the currencies of the when the minor currencies traded against the US dollar.
Okay.
So Mexico is one.
You said minor pairs are what?
When the currencies
Okay.
of countries that are not part of the is it major players now we call them now. So the major exchanges Sydney, London, New York, Tokyo are reflected on the major currencies. London Euro GBP, New York US dollar, Sydney New Zealand dollar, Australian dollar, Tokyo JPY, and then Switzerland is like the World's Bank, so that accounts for the major peers. Every other person falls under minor peers.
Are you sure?
I'm winging it actually.
Well, you tried, but there's you know there's a common denominator in major pairs, and what is that?
USD.
Exactly. So now
So
how would that?
the minor peers are the peers that don't include the USD.
Exactly. So now an example can be, so it's not really about the country that has the currency, because some of these countries you don't even need to trade them because they don't have much liquidity in their country's GDP. Like Mexico, you can trade it, but ideally speaking, why would you want to be trading Mexican whatever currency they spend? Because your chart will not move, the liquidity ratio is poor, the money in circulation is not something that is going to like affect the market, so it's not worth trading, if that makes any sense.
Okay.
And the
Yeah.
amount of spread that your broker will be charging for currencies like that is going to be ridiculous because yeah, no one trades them. So it's not about the country, it's about the common denominator, which is what?
The USD.
USD. Now, from that explanation, what are minor? Now, give me examples of minor pairs.
So that would be okay. Since it's any pair that doesn't include the USD, so that would be trading Mexican Mexican pesos,
You really like
against the
Mexico.
euro. That's the sorry, that kind of stuff because I
Bro, why on earth would you see a signal of Mexican wherever and trade it? What? And I'm not shading those people, but Mexico, what, bro? Unless you're trading it on fundamentals, or someone sends you like some news, or maybe there's a news like, oh, Mexicans are attacking the US very soon, and they want to like launch a missile, and then Trump says he's going to nuke them. Then you might trade them because the market will definitely move properly, because a lot of things are in play, which is fundamentals. But if it's technicals, it's not that it's bad, but it's just not worth anyone's time. Yeah, and it might be worth some people's time, but and even if you're using smart money concept usually works with, well, as an institution, current major currency pairs, because major currency pairs are the ones that are traded against United States dollars. So now, from this explanation, that USD is what makes a currency pair major, because it's traded against the United States dollars. So if I'm not trading you against the United States dollars, you are a minor, regardless of the country. That's when you're a minor, regardless of the country, as long as I'm not trading you against United States dollars, then you are a minor. So now from that illustration, give me two examples. Just try, but you should get it. It's quite easy.
Yeah, so euro against Japanese yen,
Good.
or Australian or Canadian dollar against GBP.
Brilliant. I hope you're not checking Google.
No, I'm not checking.
Alright, alright, that's good. That's good. Alright, in forex, what is leverage?
Okay, this is a concept I think I have in my head. Let me try and articulate it properly.
Okay.
Okay, so leverage is when you when your broker allows you to trade with to trade in terms of multiples of the capital you're actually trading with. So if for example you are trading with $50 on times 10 leverage, you put in $50, but you are actually taking positions, as it were, of $500. So it's like a way the broker allows you to amplify your capital.
Okay. Amplifying your capital, that's like the major word. Okay, now, how do we leverage in forex? You tried explaining it, but I want you to properly narrow down on that.
Okay, so you come into the market with $50,
Mm-hmm.
but your broker, who is giving you times 10 leverage, uses your $50, but opens a position for you that is worth $500.
Okay. Sorry, I don't understand.
Hello?
Are you there?
Yes, I am.
I said I don't understand.
And
Can you hear me?
that's my understanding of leverage. Essentially, it's when the leverage you do affects how much profits you make, but it also affects how much loss you make. So the higher your leverage, the higher the risk and the reward. So if the market goes your way, your rewards are amplified. But if it goes against you, your risk is also amplified.
Okay. Okay, so basically leverage is just you making use of borrowed money. And how the market works is the broker provides you with the leverage. And leverage is always done in a ratio. So there's always something called leverage ratio. I've heard of leverage ratio.
Yes, I have.
So what do you think it means?
So is the ratio of how much the broker is providing for each amount you that you bring in.
You
So if
said
it's a
sorry, you
1 to
said
10,
leverage is what?
so the leverage ratio is how much the broker is providing for each dollar that you bring in. So if it's a 1 to 10, it means for every dollar you bring in, the broker is giving you an additional 9, making 10. So it's multiplying your capital, as it were, by 10. If it's 100, then it means for every one you bring, he adds 99 to make it 100.
Huh. That is a very chat GTP like explanation.
That's interesting.
Yeah. Because most people will be like, oh, leverage is just borrowed money, and then from the English word, leveraging on what you don't have. So let's say I have $10 and then I come to my broker account. And most broker accounts have leverages of like 1 ratio 100, 1 ratio 1000. Then if I'm leveraging on that ratio, it is like I'm just multiplying it by my capital.
Okay.
Yeah. Does you understand? Do you understand?
Yeah, I do.
Are you sure?
Yes.
Okay. So let's say there's a leverage. This is a hypothetical scenario. A leverage ratio of 25 ratio 1, and then your account is $10. So much are you controlling?
That's $250
Why?
because it's multiplying your leverage. Because it's ten ratio 1 and you have $25. So that multiplies your $25 by 10
Okay.
and gives you 250.
So are we clear on leverage?
Yes.
Okay. So if you are going to be trading now, how would you determine the leverage you should use?
Hmm. Okay, that's the one I need help with.
Try. All these things are just like buying and selling. Like, okay, what would determine the leverage I want to use in the market?
Okay, so I would think one, your risk tolerance, how much you're willing to risk, and
Brilliant. But why? Explain. Like, okay, let me let you finish. Finish.
yes, how much you're willing to risk, how much experience you have, and how much information you have about the market.
Okay, so
So
elaborate on risk,
if
please.
okay, so if you're trading with money that you wouldn't bat an eyelid if you lost everything in one day, then especially if you have a small capital, then you might consider using a higher leverage because say if the risk is higher, the risk of losing your funds is higher. And because your fund is small and it's fund you can afford to lose, then if you lose it, so be it.
Well,
But
is it,
if
sorry,
you're
is
using
it,
a high
in that scenario now, is it leverage that will make you lose your money? Because don't forget the definition. I'm helping you out here. Leverage is borrowing money. So because I'm borrowing money to trade doesn't necessarily mean I will lose the money. But what determines the leverage is the amount of risk. Fine. But I'm not, you I don't like trade poorly, then I'm only leveraging on a high ratio. So let's say I bring $10 and I want to enter the market, and you know, $10 on this grand scale of $1 trillion is nothing. But if I use my broker gives me one ratio 1,000. That means my $10 can operate as what? That's one question for you. $10,000. So because I'm using the $10 in a leverage of 1:1,000, does that mean that I will lose my money, or does that put me at a high risk of losing my money? That's a yes or no question. After you answer the yes or no, I'll now ask you why. But don't be scared. You don't have to give me a perfectly right answer. Just enjoy the session and learn.
Okay, I would say yes.
Why?
Because it would mean that the market volatility will affect your funds a lot more
So,
if your leverage is higher.
do you think the market volatility is targeted to different people's leverages? And if that is even possible, how do you think that would work?
Oh wait. Okay, I see where my error is.
So, what is your hero?
I think I think to be confusing leverage and lot size.
Okay. Okay, so what is lot size then?
Okay, so lot size is the amount that you are buying with your how many units you are buying with the trade you are taking. Such that if you have $10 and you buy one unit, as opposed to you have $10 and you buy 10 units.
You know, you are not necessarily wrong. You are not right either, but you are not wrong based on the fact that leverage, we both agree that leverage equates risk. So the leverage that you're provided with, or the leverage that you have access to, is a form of determinant of the risk. Do you understand that bit?
Yes.
What does that mean?
So it means that the leverage you have the leverage you use determines how much funds you are putting at risk. Even if the funds are not yours, it's still funds that are being made available to trade with, and the funds are being put at risk.
Okay. I don't understand what you just said. Like you just used English to try and confuse me.
Unfortunately, since I didn't succeed.
So I'm your tutor, don't worry. I will always catch you. I repeat it. Monsieur.
Yeah, okay, so um, the way that your leverage affects the risk is that with a higher leverage, you are trading with more funds.
Mm-hmm.
So even if you have $10 or you are using 1,000 leverage, you are now putting $10,000 at risk.
Okay, so that means exactly. So you're putting $10,000 at risk. Now, what is the risk in play? Now, the question was that the risk, is it targeted towards you personally as a person?
No,
Okay, so how
the
does
market is completely devoid of individual identities or emotions.
good? So now, how is that risk that we've mentioned now? How does it operate in relation to leverage? You can do this. It's actually very easy. Clue. So you come with $10. Your broker provides you with leverage of 1:100. That's 10 times 100, 1,000. So your $10 is now valued at 1,000. It's still $10 in your balance, but it is valued as 1,000. So that means you can use a lot size that you can use to trade 1,000, depending on the type of broker you're using. But in most cases, you can. Now, but the risk is not allocated to you personally.
Okay.
So where is the risk allocated to? And that is also how we are going to now connect everything to this thing called lot size. But before I jump and say what is a lot size, finish this one first. You are very close. So the risk is not targeted to an individual person because the market doesn't know you as an individual. But what does the market recognize when you are trading?
The funds that you're making available.
Yeah, but
And
what we
the sorry,
the funds made available, yeah, but that is still in your own personal account. What is in the control? What you can control is the money in your account. What can the market control?
your buy order.
Well, yes, but you're still the one controlling your buy order because you're the one that decides you want to buy or sell. But what is constantly controlled by the market?
The price.
The price. Okay, but the price of what?
The price of the currency pairs.
Exactly. So the price of the currency pairs is what is controlled by the market. So if the risk factor is going to be played in a leverage form, whereby so your leveraging puts you at a risk of losing your money because you are trading at the capacity that is not initially your normal capacity, but it is your capacity that is being provided by your broker. So now if you are trading at a capacity that is higher than your capacity that the broker is making available for you in the market, then where does the risk factor comes in? Remembering that if I'm not making sense, let me know please. Remembering that this risk is not about you as a person, as an individual, according to leverage, but it is an individual thing when you're using a lot size that is high, because that is just you over leveraging using your lot size which is pertaining to you. But before we now go to you over leveraging using your lot size, how is it risky even leveraging at all in the market? Is it you coming to the market or is it the things in the market? If you don't understand, please let me know.
I think I need you to. Think I need you to break it down.
Okay, so we have leverage, right?
Okay.
So what is leverage?
Leverage is the ratio by which your broker multiplies the amount of money you're bringing into the market.
That's the leverage ratio. But what is the word itself? Like, let's come from the tiny molecular level. You're a
Okay, so
doctor.
leverage is the ability for you to trade on borrowed money.
Okay, so you're trading on borrowed money. So it is not yours, but you're borrowing it. So now, what is not the leverage ratio?
So the leverage ratio is now the factor by which the broker is multiplying your funds.
Okay, so now give me an example of a factor that the broker will multiply my funds by.
1 to 100 or 1,000.
Okay, so 1 to 100, and then you fund it $10. At what value is your $10 being traded at?
At 1 to 100, the $10 is now trading at 1,000.
Okay, not trading at 1000. Now, we now mentioned a risk factor, which
Yes.
so we are trading at the $10 is equated at $1000. Now, is this risky for you?
Not directly,
Why?
because the leverage doesn't exactly increase your risk, because it's still your $10 that is in the market,
Okay, so who is now at risk?
the broker.
The broker. Okay, So now, if the broker is at risk, how do you think the broker would mitigate the risk?
I think there's, I think it's called this spread that it's called now. So for when you enter a trade, for every time you enter a trade, there's a
But
small difference.
that's not where this conversation is meant to go to. Conversation is meant to go to, I think we are both losing the plot, or maybe I am losing the plot. So the old plot is that leverage, when you leverage, you're borrowing money, and then when you're borrowing money, you're not putting yourself at risk. I mean, you're putting your money at risk too because you can blow your account, but then you're also putting the broker at risk.
Okay.
So that, so far we've understood that part, right? Do you have any
Yeah.
questions so far?
So far, no. No.
Okay. So now the next question should now be, what determines your leverage in the market?
Sorry, I don't get that.
What determines your leverage?
Well, I think it would be a factor of how much capital you are bringing in and the factor the broker is willing to give you.
Okay, so I won't really say capital, but that should not also be neglected because if you open some live account and you deposit some amount of cash, they won't allow you to use some high leverage, but that is also based on the brokers, not based on the capital. So capital is not part of it. Yes, brokers policies, some brokers will not allow you to leverage to a certain amount of level because why? You're putting the broker at risk. Now, what do you think again determines the leverage in the market? I feel like we've missed something
I
that we
think
were
the
meant to hit on.
I think the volatility
Volatility. Okay. Volatility of what?
of the currency pairs you're trading.
Okay. Well, you shouldn't just say currency pairs. Use the terminology instruments because back in 2020 to around 2022, I wasn't trading currency pairs. I was always trading volatility indices. And indices are just, well, volatility indices in it, a form of commodity. That's synthetics. So use use instruments, not currency pairs, because there are traders out there that don't even trade currency pairs at all.
Okay.
Okay. So volatility of your instrument. Why? Ooh, it's already 1 hour.
Yeah.
Our class is 1 hour.
Oh, wow.
Yeah. You know what?
Okay.
Let's wrap this up.
Okay. Um. Okay. Honestly, I'm stuck at this point. Um.
Okay. So the thing is, you
But
are
the question
trading.
is how is what determines your leverage, right?
No, this particular question is that you said, yeah, what determines the leverage? And you now said the volatility of the currency pairs. So I said she knows currency pairs that she use instruments.
Is the instrument, the
So now,
volatility of the instrument.
so now how does volatility of instruments determine your leverage?
Oh, okay, I get. The leverage is the choice that the broker gives you. But wait,
Exactly.
okay. My thinking why I said that is that the higher the volatility,
Uh-huh.
the the higher the risk.
Mm-hmm.
So if you're trading very volatile instruments,
Mm-hmm.
some brokers won't allow you to use a very high leverage
Brilliant. That's what
because
I've been trying
that
to get to
also
since.
puts them at risk.
Exactly, because if you are trading something that is very volatile and then you're using high leverage, remember that your brokers are also losing money
Yeah,
because they are borrowing you money. So when you're leveraging and you're going to the market, they're losing money based on your money. But because they are losing money, they can also make money.
yeah.
If that makes any sense. Okay. All right. Well, this is where we'll end to this class. Today's class was just us gisting. Tomorrow we'll start properly and we'll have like a scheme of work. So I'm gonna send you a coupon code to get access to the course on the website. Then we are going to use the curriculum there to start our training.
Okay.
All right. So nice
Yeah,
talking to
thanks
you.
a lot.
No
Yes,
worries.
thank you.
Hope you had a nice class.
Yes, I did. I did. Thank you.
All right, no problem. I'm having class with your kids by 4 p.m.
Oh, great. Okay. Yeah,
Okay.
thanks a lot.
No worries. All right. Have a good one.
Yeah. You too.
All right. Cheers. Bye.
Yeah. Bye.
All right. So that was a one-on-one class session with the students, and that wasn't an actual class. That was just a conversation session. Actual class starts tomorrow, so if you want to know how it goes, like and subscribe and stick around. Ah, yeah. Because with him, his previous tutor abandoned him. One tutor I assigned him to, so I'm taking it myself. I try to always make sure my students get what they pay for, and sometimes tutors are crazy. So yeah, I should get a new couch, but right now I'd rather put the money into training secondary school students on AI. So once again, if you're watching this and you have access to hundreds of millions of dollars, please fund my company. I am doing the Lord's work. Support Misfit Academy, support Misfit Architect, support Misfit Multi Business Ventures. Thanks for watching.